There's a very specific kind of nightmare I think we've all had at some point. You're in a high-stakes meeting, or maybe you're sitting in a massive exam hall. You've got the calculator, you've got the spreadsheet, you've memorized every single formula. You are, technically perfect, and yet you are completely spectacularly wrong.
It's the classic forest for the trees scenario. I mean, you're so busy calculating the third decimal point, you forget to look out the window and check if the building's on fire.
Exactly. And that is exactly what we are unpacking today. We are doing a deep dive into the ACCA Advanced Financial Management Examiner's Report from late 2025. And before you reach for the skip button thinking, an accounting exam report, really, stick with us.
Yeah.
Because this is not about passing a test.
No, not at all. These reports they're fascinating because they're essentially a catalog of human error in high-pressure financial situations. We're looking at thousands of aspiring CFOs, people trained to handle money, and watching them make the same psychological and strategic mistakes over and over.
It's like a postmortem for business judgment.
It is. It's a masterclass in professional judgment, or, maybe the lack of it. It reveals that gap between being book smart and having actual commercial sense.
So we have 3 case studies to get through today. Drimton, Hostock, and Passmore. Each one highlights a different way that, smart people trip themselves up. We've got ethical blind spots in manufacturing. We've got buzzword traps in M&A, and a very cold dose of reality in foreign exchange markets.
And if there's one theme connecting all of them, it's this. Candidates are getting better and better at the math. The spreadsheets look beautiful, but they are failing to ask the most important question, which is, does this actually make sense?
Which is terrifying if you're hiring one of them to run your treasury. So let's jump into the first case study. Drimton Co. Set the scene for us.
So Drimton is a large listed company based in a developed country called CompTIA. They make air conditioning units. Pretty standard stuff. They want to expand, so they're looking at setting up a manufacturing subsidiary in a place called Edreiser, which is part of new single market, the Central Trade Area, or CTA.
Okay, classic corporate strategy. Build where it's cheaper, sell where the demand is.
On the surface, yes. But the first hurdle was a question about commercial advantages. The examiner asked, what are the benefits of setting up a factory inside this trade area?
I feel like I know the answer. It's to sell more air conditioners, access to the market.
That is what the vast majority of people wrote, access to the market. But here's the catch, and this is where reading the fine print really matters. Drimton was already exporting to the CTA.
Oh.
They were already selling units there. They had the access.
So simply building a factory there doesn't magically create new customers.
Exactly. If you're already selling to the market, building a factory there isn't about sales growth. It's about logistics. It's about supply chain friction.
Right. It's about cutting out the headache.
It's about removing non-tariff barriers. We're talking customs delays, regulatory hoops, transport costs, the risk of the border closing. The real commercial advantage is becoming a local player so you can deliver faster and cheaper. But the candidates, they just missed that nuance. They saw trade area and their brains autopiloted to sales growth.
That's a great example of generic thinking versus specific analysis. But I know things got messy with the numbers too. This was an investment appraisal, right? Calculating net present value.
It was. And for those who might be a bit rusty, net present value, or NPV, is just a way of calculating if a project is worth more than it costs.
Right.
Adjusting for the fact that money today is worth more than money tomorrow.
Right. Discounted cash flows.
The big technical trip up here was inflation. And this is a mistake I see in real-world budgets all the time.
Inflation seems straightforward enough. If costs go up by 5%, you add 5%.
In year one, yes. But a surprising number of candidates treated inflation as a one-off bump. They added 5% in year one and then just kept that flat amount for years 2, 3, 4, and 5.
Oh, I see. They forgot the compounding.
Precisely. If inflation is 5% this year, next year's 5% is on top of that new higher price. It stacks. By the time you get to year 5, the difference between a flat increase and a compounded one is, it's massive.
So if you make that error in the real world, you're basically underestimating your costs by millions of dollars.
You end up with a huge budget hole that just destroys your profit margin, all because you treated a compound variable as a linear one.
That's a technical error, though. You can fix that with a better spreadsheet formula. But the report mentioned something else about Drimton that sounded more behavioral, something called fence sitting.
Ah, yes. This was the part of the report that was probably the most scathing. The requirement asked the candidates to recommend yes or no. whether Drimpton should proceed with the investment.
Seems like a standard request.
You would think. They did the math, they filled out the complex spreadsheet, they calculated the tax, and then nothing. Or they wrote something vague like, it depends on further analysis.
They didn't make the call.
They refused to get off the fence. And the examiner was very clear. In a boardroom, it depends is not an answer. Your job as a financial leader isn't just to present the data, it's to synthesize it into a decision.
That's actually a really difficult hurdle for people, I think. We're taught to show our work, but we're scared of being wrong on the final answer. So we hedge.
It's risk aversion. But in this exam and in business, fence sitting is a failure. If you present a beautiful spreadsheet but refuse to say we should do this, you aren't adding value. You are just a calculator.
Now, speaking of difficult decisions, we have to talk about the ESG aspect of Drimpton. This is where the report gets really interesting, about the clash between ethics and, well, business logic.
The environmental, social, and governance curveball. So remember, Drimpton is setting up an Edreiser, which is a developing country. They plan to pay the workers there the local average wage.
Which is naturally much lower than the wage in the rich home country of CompTIA.
Much lower. The question asks candidates to discuss the issues with this policy and suggest a solution.
I can predict the answer here. I mean, the instinct is to say, that's unfair, pay everyone the same.
That is exactly what the majority of candidates argued. They took the moral high ground. They said, it is unethical to pay Edreiser workers less than CompTIA workers. Drimpton should pay everyone the same global wage.
Okay, play devil's advocate for me. Why is that wrong? If I'm a multinational with deep pockets, why shouldn't I pay my factory worker in the developing world the same as my worker in the US or UK? Isn't that the definition of fairness?
It feels like fairness, and I think the candidates' hearts were in the right place. But it fails the test of commercial acumen. And actually, if you look deeper, it fails the test of economic ethics, too.
Oh, so?
Well, think about the consequences. If you drop a factory into a developing region and start paying London or New York wages, what happens to that local economy?
Well, everyone would want to work for you.
Exactly. You drain the talent from every other local business. Schools, hospitals, local shops, they can't compete. You create a massive wage bubble that drives up local inflation, making life more expensive for everyone else who doesn't work for you.
So you inadvertently destroy the local ecosystem.
You disrupt the local labor market completely. Plus, you're ignoring purchasing power parity. $1 in Edreiser buys 5 times as much as $1 in CompTIA. So paying equal nominal wages actually creates massive inequality in terms of lifestyle. The examiner flagged this as a lack of commercial acumen.
That is a tough lesson. It's the difference between textbook idealism and real-world economic impact.
It is. It's about understanding that fair is relative to the local context, not just a universal number on a payslip.
Right.
Drimpton is there because costs are lower. If you equalize the costs, you remove the business case, the factory closes, and nobody gets a job.
Right. It's about sustainability. Okay, let's move to the second case, Hallstock Co. We're shifting gears from manufacturing to mergers and acquisitions.
Yes. Hallstock is a high-end, premium fitness club chain. Think luxury spas, expensive memberships, fluffy towels.
Cucumber water.
The cucumber water, yes. They want to buy a company called Marnhall.
And let me guess, Marnhall is not a luxury brand.
Far from it. Marnhall is a budget, low-cost gym chain. No frills.
A classic mismatch.
A massive strategic clash. Now, the question asks candidates to act as a skeptic. The non-executive directors were worried about the revenue projections. The candidates had to explain why those projections might be dodgy.
This is the synergy trap, isn't it? Executives love to say 1 + 1 = 3.
They do. The model assumed that by combining the companies, revenues would just skyrocket. But candidates failed to challenge this. They just accepted the growth numbers provided.
Why shouldn't they? If you have more gyms, you make more money.
But look at the customer base. The customers at Marnhall go there because it is cheap. If Hallstock takes over and tries to premiumize it, raise prices, add services they don't want, put in the cucumber water.
Those customers won't stay. They're price sensitive.
Exactly. They will just go to the next cheap gym down the road. So the synergy revenue is a phantom. It disappears the moment you try to capture it.
And the examiner was looking for that level of skepticism.
Yes. They wanted candidates to ask, why do we think we can charge premium prices to budget customers? Most candidates just crunch the numbers given to them without asking about the human behavior behind them.
Speaking of crunching numbers, there was a specific calculation error in this one that sounded, well, like something out of a sci-fi movie, the infinity error.
Ah, yes. This happened in the valuation. When you value a company, You usually forecast cash flows for a few years, say 4 years, and then you calculate a terminal value for everything after that.
Assuming the company runs forever, in perpetuity.
Right. Now, the question explicitly stated, after year 4, cash flows will remain constant. 0 growth.
Simple enough.
You would think. But many candidates have memorized a formula for growing perpetuity, where the company keeps growing by, say, 2 or 3% forever. So, despite the instructions saying constant, they just plugged in a growth rate.
They added growth that didn't exist.
They created value out of thin air. It's just muscle memory. They saw perpetuity, and their hand just wrote the growth formula. But when you add even a small growth rate to a perpetuity, it has a massive impact on the valuation.
So they massively overvalued the company because they were on autopilot.
Precisely. They ignored the specific instruction in favor of the formula they memorized. Imagine presenting that valuation to a board. You're telling them the company's worth 30 or 40% more than it actually is.
That is terrifying. But it gets worse, right? They also got the purchase price wrong.
This is a lesson in negotiation logic.
Yeah.
The owner of Marhall said, I want $160 million. That was his ask.
Okay.
But the candidates calculated the fair market value at about $145.8 million.
So there's a gap. The owner wants more than the spreadsheet says it's worth.
Correct. But when asked to calculate the gain to the shareholders from the deal, many candidates used the 145 figure as the cost. They assumed they could buy it for what it was worth, not what the seller was asking.
But the seller said 160.
Exactly. Unless you plan to negotiate him down, you have to use the asking price. By using the lower number, they made the deal look profitable. If you use the real 160 price, the deal actually destroyed shareholder value.
So again, it's seeing what you want to see. The deal works if I use the theoretical price, so I'll use that.
It's a lack of realism. In M&A, you pay what you agree to pay, not what your spreadsheet says is fair.
That brings us perfectly to the final case, Passmore Co. This is Treasury and foreign exchange. Now, usually, this is where people get tangled up in complex hedging math.
And they did.
Yeah.
But the biggest error was surprisingly simple. Passmore is a U.S. company expanding into India. They were expecting a receipt of 202 million rupees.
A receipt. Money coming in.
Yes. They are selling something, getting paid in rupees. They need to convert that back to dollars. A huge number of candidates treated this as a payment. They set up their hedge to protect against spending rupees.
Oh, no. So they bet on the currency moving in the completely wrong direction.
They inverted the hedge. If the rupee loses value, Passmore naturally loses money on their revenue. But the candidates set up a hedge that pays out if the rupee gains value. So if the rupee crashes, the company loses on the revenue. A&D loses on the hedge.
They doubled their risk.
They speculated against their own cash flow. In a real Treasury department, that's a resume-generating event. You are fired before lunch.
That is just fundamental reading comprehension. Receipt versus payment.
It is, but let's say they got the direction right. They then ran into the whole number problem. This involves futures contracts.
Break that down for us.
So a future is a standardized contract on an exchange. You can't just buy whatever amount you want. It's like buying eggs. You buy a carton of 12 or you buy nothing. You can't buy 4.3 eggs.
Okay, that makes sense.
The math in the exam indicated Passmore needed to hedge a specific amount, which worked out to be 40.4 contracts.
40.4, so what's the answer?
The practical answer is 40. You round down, you hedge the bulk of it with the 40 contracts, and you leave the little bit unhedged, or maybe you use a different tool like a forward market for the leftovers.
And the candidates?
They left the answer is 40.4, or they tried to construct complex ways to buy 0.4 of a contract.
Which is impossible.
It is impossible. It shows they view this as a math problem, not a real-world transaction. A trader knows you click buy 40. A student calculates 40.4. The examiner wants to see the trader mindset.
It really highlights the theme here.
Yeah.
The exam isn't testing, can you divide X by Y? It's testing, do you know how the market actually functions?
Exactly. And this led into the final question about the Treasury Department itself. The CEO asked, how can this department make a positive financial contribution?
Show me the money.
Yes. But candidates wrote essays on administration. Centralized Treasury is good for reporting. It avoids duplication of roles.
Which is true, but
it doesn't make money. It saves administrative headache, but it doesn't add to the bottom line. The CEO asked for financial contribution. They should have talked about tax planning, minimizing bank fees, investing surplus cash more effectively.
Again, answering the question you wanted to answer rather than the one you were asked.
They just recited the textbook chapter on centralization pros and cons instead of thinking about the CEO's profit motive.
So we've looked at Drimpton, Hallstock, and Passmore. And there's a thread tying all these disasters together. The ACCA calls them professional skills.
Analysis, skepticism, and commercial acumen.
It feels like skepticism is the one people struggle with the most.
It is the hardest to teach. We are conditioned to trust the paper in front of us. In Hallstock, candidates trusted the revenue growth. In Drimpton, they trusted the moral argument on wages. In Passmore, they trusted their calculator over common sense.
It's almost like the education system trains us to find the right answer, but the business world is full of wrong assumptions disguised as facts.
That is the core conflict. In school, data is truth. In business, data is just an input, and often a flawed one.
So let's wrap this up. If our listeners are looking to sharpen their own professional judgment, whether they're taking an exam or just running a budget meeting, what are the 3 big takeaways?
Number 1. Context is king. That's the Drimpton lesson. Don't just apply a rule like pay equal wages or add inflation without looking at the specific economic reality. Does it compound? Does it destroy the local labor market? You have to look at the second-order effects.
And number 2.
Read the fine print. That is Hallstock. If the prompt says constant growth, don't add growth. If the price is 160, don't use 145. You can't value a deal on fantasy numbers. You have to deal with the constraints you are actually given.
And the 3rd.
Reality works in whole numbers. That's Passmore. Know which way the money is moving in or out. And remember that financial instruments have real physical limitations. You can't buy half a contract.
It's a masterclass in details.
It really is.
I want to leave everyone with this final thought. The examiner explicitly noted that candidates are getting better at the math. The technical calculations are improving year over year, but the skepticism is lagging behind. Why do you think that is? Why is it so hard for us to just say, wait a minute, this looks wrong?
I think it's because skepticism feels like conflict. To question the revenue numbers is to question the person who wrote them. To question the moral wage is to risk sounding unethical. It takes, confidence to be the one who stops the meeting and says, the emperor has no clothes.
But that's exactly what a high-level financial leader is paid to do.
It is the most valuable skill you can possess. The software can do the math. Only you can do the thinking.
That's a powerful place to end it. Next time you see a spreadsheet, don't just check the sum formula. Check the assumptions.
Always.
Thanks for guiding us through the minefield today.
A pleasure.
And to our listeners, thanks for diving deep. Keep questioning the data. We'll see you next time.